Well, hello everyone. Welcome to the June Masterclass. Now, this is a pre-recorded masterclass. The reason we're doing that is because, as you may or may not know, I'm on a sailing catamaran and we will be in the ocean, sailing across the top of Australia and into Indonesia when this comes out. So, thought we better honor our pledges and make sure that you guys have a masterclass for the month of June. So, welcome to this one. Now, this one is titled The Ultimate Cash Flow Tips for the Financial New Year. So, it's not going to go as long as normal ones. You won't get as much waffling as per normal. So, but I hope this gives you some idea. I know we're all feeling the squeeze this year. The economy is sort of starting to sort of bottom out, or certainly people are feeling the pinch a little bit more as the cost of groceries and petrol and rents and other bits and pieces go up, and as interest rates go up as well. And that means that they're spending less discretionary spend, or even they're deferring non-discretionary spend, which is hurting business people. We understand that. So thought this might come in helpful, some cash flow tips for the new financial year. So without any further ado, let me jump into it. Okay, so cash flow is extremely important to understand, and that is it's not as obvious as what people might think it would be. So obviously we've got inflows from the sales of goods and services, but if you have customers who pay you on terms, then that doesn't necessarily result in cash in your bank account at that point in time. What it does sound like a sale, and you may well have to pay GST on that income even before you've received the money, or certainly not long thereafter. So it can be a problem. Your suppliers, people who you get your goods and services off, if it's a service and mainly you're paying for things like rent, which is sort of non-negotiable, you're going to have to pay that on a fixed time during the month. Or it's employees where you have to pay them on time, otherwise there's big problems. It's more when you're getting your suppliers who are more at a discretionary payment. They may have payment terms. You might buying some goods off them, and you only have to pay them back at a certain time of the month. Hopefully you've sold those goods and been paid for them, but if you haven't, then that can cause some cash flow issues for you. Also, you might choose to spend some of your hard-earned dollars in the bank on things like assets, or you might think on, or discretionary expenditure. You might buy a new computer, or you might hire a new admin person. So all of these things are important to understand as well, that they have a negative impact on your cash flow. That's cash out without necessarily receiving any cash in. So your cash in has to support not only the suppliers, your employees, rent, all those sort of things, but it also needs to support your purchasing of assets. Also, when you repay a loan, so when you borrow money, that's obviously an increase in your cash flow. When you repay that loan, that's cash going out. So these aren't always cash in your bank isn't always represented by just what you sell, less how much it costs you to sell. There's also a whole bunch of other things that impact your balance sheet, which is going to have an impact as well. And that's where you get things like working capital. Now, working capital is the amount of money that you need to have in your bank account to support all the timing differences from your inflows and your outflows. Okay, that's the end of the technical accounting 101 lesson. So I'll crack on to the next slide. So I've got that, as I say, definition and importance, the cash flow, incomes versus outgoings, whatever's left in your bank account at the end of the day, or bank accounts. It can be multiple bank accounts. That is your cash at end. So it's the difference between your cash in beginning and the cash at end. That's the cash flow, and it's either a positive or a negative. So important, because many good businesses have been ruined by a lack of liquid funding, because cash is king. And when we say cash in this instance, we don't mean folding stuff or coins. We actually mean just the ability to go into your bank account and make a transaction. So the numbers represented in digital format on your bank account now, it represents cash, and that is king. So it's not just the folding stuff. I've gone through the components of cash flow, so I won't go through them again. That's that's your inflows versus your outflows. Um, and I've explained why you can make profits in your business and still be negative cash flow, and that's because it could be timing differences of when you had to pay your suppliers from last month, which might still be in profit, but it's just going to mean that you're having a timing difference for the period of profit. So I know I said this was the end of Accounting 101, and I do apologise. I'll just go back slightly and just say, when we're looking at profit, we're looking at, if I want you to imagine a river. We're on a body of water at the moment. Could be a river, and it's a timing. You have a starting point, and down the stream a little bit, you have an end point, and it's the flow of cash that goes from one point to another. That's how we measure profit. Balance sheet, or the amount that you've got in your cash at any one point in time, could be at any point on that river. So it's something to, cash flow and profit are from one period to another period. It's the flow of incomes and outgoings through your business. So hopefully that helps with cash flow. Okay, so assessing your cash flow situation. All right, this can be extremely difficult. And I know this. I used to do consulting gigs back in the early days of my accounting practice. And I'd go through people's bank statements and work out, well, when was they paying their rent? When did they have to pay their staff? When did they have to pay their suppliers? All those sort of terms. Come up with complicated spreadsheets that I don't know if you've ever heard, that the best plan only lasts until the first shots are fired. That's like a analogy. There's also an analogy there that Mike Tyson says that everyone's got a plan in the ring until you get punched in the face, and I think that's true of all of these cash forecasts and complex spreadsheets. But it does start with reviewing your financial statements, because we want to see things of what your inflows are during a certain period, what your outflows were on your profit and loss, and then we look at things like repayment of loans, payment of liabilities, and also payment of things like payment of dividends. All of these are coming out of your bank accounts, so they affect your cash flow situation. So we really need to start with reviewing your financial statements. Then you identify those patterns. So you're sort of saying, well, we know we pay the rent on the 15th. We know we pay salaries, twice a week, and now on the 7th and now on the 21st. So you identify those cash flow patterns, those things that are going to be, and we pay suppliers once a month on the 17th, whatever it is. You identify what you have to pay. Your hire purchase on your car and your equipment gets paid on the 5th and the 15th. Whatever that is, you're identifying those cash flow patterns, and that's giving you an idea of what actually the incomes are versus the outgoings. And then you can apply some tools like Excel spreadsheets or Google Sheets. As I say, I used to have really complex sheets. I'm not a big believer in those anymore because I think they don't stand the test of time. I don't think they're that practical. Techniques might be profit first. So profit first is a great idea of a technique. You're calling it a tool that would help you manage your cash flow from one period to the next period. There are different ways of analysing things. There's special software that you can use that will help you identify various patterns and understand where things are. Basically, it comes down to if you're not selling enough or you're paying out too much. It's kind of the stuff that you know in your gut that's going to make the biggest impact on your cash flow. So you just hold back your expenditure a little bit. Stop putting money out where you can. Stop signing up for things where they take your money automatically, and start making sure that your customers are paying you on time or preferably in advance of doing your service. Of course, if you're selling a good, just make sure that they can pay you up front, or you can use a tool, maybe you give up a little bit like a credit card or a hire purchase or smart pay, that sort of thing that might get you paid sooner, and let the customer pay when they can. Okay, so the next one, strategies for improving cash flow. And I'm sure you'll be, eager to hear the wisdom of me and my experience from some of the strategies for improving the cash flow, because that's ultimately what you want to do, because everyone suffers. If you're not suffering, then maybe you've got too much cash in your bank account. And when I say suffering, I just mean add a little bit of tension. There's a tension line that you want to maintain so that you're not always feeling flushed with cash. You can have them in reserve accounts so that you've got backups, but you really want to make sure that you're getting the very most out of your cash flow, that it's working as hard for you as other assets are expected to in your business. So first of all, enhancing your cash flows. Okay, well, sell more. Sell more, make more profit by raising prices. So increase the volume of your sales or increases your prices are two very standard ways that you can increase your cash inflows. It could also mean cutting down your terms or eliminating terms from your customers, or just phone and getting those collections. So enhancing cash flows can be done in those ways. Reducing the cash outflows, and this sounds like, oh wow, obviously, if you enhance your cash inflow and you reduce your cash outflows, you'll get better cash flow. That's right, but it's amazing. Like, people will sign up to subscriptions, or they'll get a bigger car, or they'll rent a bigger premises before you actually need to. So maybe you need to look at, if you want to improve your cash flow, you might want to reduce those cash flows. Just delay buying things that you don't necessarily need. Now, suppliers are something that's an interesting thing as well. And, often people will just pay a bill when it's due, or they just go, oh, there's a bill, or they pay it as soon as it comes in. That's lovely. But in today's day and age, I think you can actually afford to just say, look, we only pay all our suppliers on the 15th of the month, or whatever date you choose, and just pay them once per month. They'll understand. If they say, hey, that was due on the 1st, you say, that's okay. We only pay our suppliers on the 15th. And if you've got a good enough relationship with them, then they'll say, oh, okay, that's fine. And you pay them on the 15th. You make sure you honor your promises. And then it's amazing how lenient your suppliers will be with you, because they know they're going to get paid. They're going to get their cash at the end of the day. They just might have to wait a couple of weeks. Oops. Oh, no. My face is in the way of this, but managing debts and liabilities. So this is one, there's a technique called a cash snowball, a debt snowball. And it's counterintuitive to you. You would think when you're managing debts and liabilities in general, that you would go from, that you could look at a consolidate. So say you've got 5 different credit cards, and you've got lines of credit, you've got other bits and pieces, loans from friends and family. You could go to one consolidated debt position. They could take all of those loans, and then you just have one loan that you're paying a very high rate of interest on. We definitely don't recommend that. That's not what we're talking about here with a debt snowball. The other thing you could do is, that you pay the most amount of interest on the largest balance, right? That just sort of makes sense, unless you've borrowed a bunch of money off your parents and you don't have to pay them back any interest. Typically speaking, if everything's on an arm's length basis, your largest debt is where the most interest you're going to be incurring. But rather than tackle that big one, what we want to do is affect your psychology as well. So a debt snowball is where you tackle the smallest debt first. And the reason you do that is because, you might be paying someone $25 a month, and that includes, $20 principal and $5 interest. I want you to pay that debt off. I want you to just say, okay, I need it. That's $2,000. We're going to do everything to save up $2,000, and then we're going to pay that smallest debt off first. And then you've got that $25 to apply to the next biggest debt. But you've got, psychologically, it's like, wow, paid that debt off. Who's next? The next biggest one. Who's next? The next biggest one. And you will be amazed by doing that, how quickly your debt snowball reduces. But you think of like a snowman, the biggest debt is last. You've got the small ones, the head gets knocked off, then the body, and then the legs down the bottom. So totally recommend that approach. Try it. It works. It might sound counterintuitive for you, but you'll find yourself saving a lot of interest and really getting on top of those debts and liabilities. So definitely think you should do that. Don't worry about consolidating them. This is not individual advice, by the way, but I would really recommend against consolidating your debts. If you can, just knock them off one at a time, smallest to biggest. Maintain your repayments on every other debt, on all of your debt at the same time. It's just you can knock them off one at a time. And things like ATO, if you find yourself in a bit of a cash flow crunch, The ATO is the easiest place to get a loan because they will give you a payment over your payment plan over your outstanding tax liabilities automatically if it's up to $20,000, or you might have to go through a tax agent or explain to them why you want more if it's a higher debt. Now, you will have to repay that back principal and interest, mainly principal, and the interest gets added on to the end. And a lot of the time, they can reduce that interest. If you paid it off quickly, they'll eliminate the interest charges on it. So you can do that. One of the tips and traps for young players on this is to make sure that if we're coming into June, the end of June, make sure that you lodge your BAS for the last quarter before you go and get a loan. So you've put all of that stuff on, because once you've got that debt arrangement with the ATO, you need to make sure that you pay everything as and when it's due. So make sure you've got it in place as well. I think that'll serve you well. Okay, so forecasting and budgeting. This is something I'm not necessarily a massive fan of because I think it can be really complicated and doesn't often stand the test of the heat of battle, if you like. But that said, it is important to know when you got big debts due. So let's take an example. You know your monthly expenditures. You know how much you're going to have to pay for your salary and your rent, and how much you generally have to pay for your electricity and telephone, all of those little things, and any subscriptions that creep into you. You'll know about that. But then you're going to get big shocks, like if you might have a big supplier payment coming up. The ATO is a classic one where a lot of people have their quarterly BAS and they need to pay that. By the 20th or 21st of the month following the quarter, or 2 months following the quarter, depending upon whether you're using a BAS agent or not. Highly recommend you do that. But if you've been keeping some aside, then you should know that these expenses, this expenditure is coming up, and you can make sure that you've got enough money for it. Same with if you want to buy an asset. Unless you're financing it, if you want to pay cash for it, a new computer, say you want $3,000, if you can make sure you've got enough money in the bank, that you haven't got a particularly heavy cash outflow month, then you can pay that computer. So whilst there's a lot of tricks and a lot of tools on the market for forecasting in great detail, I'm a big believer of gut and a review of your profit and loss and balance sheet to say, okay, is there anything coming up next month that I should be aware of, and making sure you've got the cash reserves to meet those payments. Steps to creating a cash flow forecast. Well, I guess first of all, a spreadsheet is a good place to start with a forecast. And I would list all of your bank accounts at the top of those because that's all going to be your opening cash balance, if you like. And then down the left-hand side, it's a great idea to categorize things rather than list every little individual thing, which you can do. It just makes it very unwieldy. But I would say, employment costs, salary and wages, occupancy costs, so that might be your rent, your light, your electricity, your telephone, so group-like transactions down one side, and then just put in, month one. It might be weekly, it might be monthly. I don't recommend weekly. I don't like it. I think monthly is a much easier way to do it, and it yields you better results at the end of the day. So if you just do it monthly, these are all the monthly outgoings. Put in your forecast for your sales at the top, so your income, any loans that you're going to get or monies that are due to come back for you. Might be shares that you might be selling or loans that you might be taking out. Put all those in the inflows, and then list all the outflows. Get all those from your profit and loss or your bank statements if you have to. And then you can list those and then add them all up. So it's obviously opening balance plus all of your inflows of money less all of your outflows equals your closing cash balance. Now, I'm just going to give you one more quick formula that you can also use to simplify things. If you have all of your inflows less your outflows for the month, that equals your net cash inflow or outflow. And it might be all your debt repayments, all that sort of stuff might be in there. And don't forget, there's one little offside trap called depreciation, and there's also provisions if you're providing for annual leave and things like that. They're expenses, but they're going to be non-cash expenses, so you don't need to worry about those things from a cash flow perspective. So you've got your net inflows or outflows, and then it's just your opening bank balance plus or minus your net cash inflow or outflow equals your closing balance. And you can see, list your bank balances at the bottom, and you'll see, okay, this one will have this much, this one will have this much, based on whatever policy you've got in place. It's a little bit tricky in 2 minutes to explain exactly how to create a cash flow forecast. As I've said, I'm not a massive fan of hyper detailed ones, but I think a broad brush one can really help you with your cash. And then creating a realistic budget around this. I mean, sometimes you're doing a cash flow forecast and you see, wow, I'm actually in trouble here. I've got too much outflows and I'm not going to be out. My cash is going negative, but I don't have an overdraft. So in that case, you really might have to move things around and say, well, I can't afford to pay the ATO this month. I'll have to push that out to next month. So it's a realistic way of forecasting and then creating a realistic budget as well. So you know exactly how much that you can spend given your level of income, or maybe you have to just say, I need to sell a lot more in 2 months' time, otherwise I'm going to be in trouble. So I'll put a sale on, or I'll double down my efforts of cold calling, whatever it is, but you need to sell more if you've got a problem in 2 months with your cash flow. So coming near the end now, who can help with cash flow management? Well, first of all, there's financial management software. So Xero will do a bit of a job of giving you give you an idea of cash flow. But as I said, it's quite complicated. There are packages available on the market that you can just invest in and give you. They'll take your Xero or your QuickBooks or your MyOb numbers and they'll crunch them around. They'll ask you to put a whole bunch of assumptions in, and then rather than creating a spreadsheet, they'll spit out an answer for you. Now, whether that's good or not, whether it's accurate or not, in my experience, it's not great, but it might give you some trends and ideas about how cash flow is going to be managed. Automation tools, they sort of fall into the same category there. Online banking and financial services. So you can definitely, if you've got your bank statements there, you'll notice that the Commonwealth Bank and others will give you the ability to add a budget to your bank account. So each bank account can have, and you can just categorize things as they go through your bank statement. And then you can look when you just go on net banking. I'm sure the other banks do it as well, but I know Commonwealth Bank does it. You look on your net banking and it'll tell you exactly where you're sitting from a cash flow management perspective or your budget for the month. And obviously your bookkeeper or accountant. So some bookkeepers, certainly financial fanatics, can help you with cash flow management and tools. Your accountant definitely, and also profit. Let's not forget profit first. If you know me at all, I'm a passionate advocate of profit first as a system for managing your business, financially managing your business, and that's just where you take a percentage of the inflows of your business, of the income, and you spread it out to a number of different bank accounts that helps you know, if I've got X dollars in my profits account, that's how much profit I can afford to pay myself. If I've got X amount in my GST account, then that's always going to be available for me. I'm never going to have those shocks. Definitely get your bookkeeper and accountant. I've tried to make it sound really simple, and I hope I haven't oversimplified it, but your bookkeeper and your accountant can definitely go through and help you out with a cash flow forecast or your cash flow management in general. If you find you're having problems making ends meet, then definitely they might be the first people to go and talk to rather than rushing out and getting another loan. So definitely recommend that. Okay, so on to this one, practical tips and best practices. Okay. You really need to be looking at your financials on a regular basis. Let's not leave this to once a year. Now, I know I have just today, it's now the 17th of June when I'm recording this. I know that I've just got my super fund for the year ended 30th of June 2023. So that's not very practical. If you wait for your year end, your accountant to come back and give you the results, that's not really very helpful, is it? We're now nearly at the end of 24 and I'm just getting the results of 23 and going, maybe I should have saved some more money in super, or maybe we should, change our policies. But that was based on a year ago. So that's crazy. Regular financial reviews, let's make them monthly. Let's make sure you're looking at your bank account balances weekly, or certainly your operating ones. It could be daily if you've got tight cash flow issues. So definitely review your bank accounts regularly, your profit and loss at least monthly, and your balance sheet at least monthly as well. And then you'll be on top of things. You need to make sure it's up to date. Again, your bookkeeper can help you with that, and your accountant can help you with that, but make sure that you're able to do regular financial reviews. It doesn't necessarily mean sitting down with an accountant on a quarterly basis. It might, if you think things are really tight, it might pay you to spend an hour and really go through your finances and understand where things are up to for that period. Building an emergency, and this is Profit First 101, right? But if you can build an emergency fund, and I say 3 months of operating expenses, if you got no income whatsoever, if there was a massive shock, don't say it'll never happen. Remember COVID. Remember when they shut down a whole bunch of businesses, especially in the hospitality industry or tourism, travel, all those sort of stuff. Those guys had rent that they had to pay. They had staff that they might have had to pay, and they weren't getting any income whatsoever. So build an emergency fund of 3 months in your business, and I recommend that you do 3 months in your own personal expenses as well, which might be your rent or your mortgage payments or whatever it is, food, groceries. Work out what you spend in a month and then times it by 3, and that will be your emergency fund. And when you do that, you'll always be able to borrow from that emergency fund. If you've got a short-term cash flow issue, put the money back, make sure that you top it back up once the emergency is over. But it is an essential thing for the longevity of every business and the sanity of every business person to have some sort of emergency fund. Stay informed and educated. Not with my big head over educated, but stay informed and make sure that you know exactly where the inflows are coming in your business and where the outflows are going. Don't just say, I don't know what happened to the bank. But if you keep buying equipment on hire purchase and you don't make sure that you're utilizing that equipment, then you could be in real trouble. So make sure you stay informed and educated on everything that's going on in your business and the best cash flow management techniques and tips. All right. Well, that's all we've got for today. I hope you found that quick and entertaining. If somewhat useful. If anything has sparked an interest, please don't hesitate to reach out to our team. And they can help you work through some of these issues, create that cash flow spreadsheet if you like, or even talk about Profit First if that's the way that you want to go, or you can contact Profit First Australia as if you don't want to go down the whole pathway of understanding and knowing, predicting every single thing that's going to happen to your business on a minute by basis. I just don't think that's practical, guys. I know I might be at odds with other financial professionals on that, but from a personal and a business perspective, I think having an overview of what's going on is really, really important, and then having those emergency funds is a lot better, and then making sure your accounts are always up to date. So that would be my sincere advice. So reach out to our team. Thank you so much for listening today. Please don't hesitate to give us some comments. And once again, we'll be live. This time I'll be coming to you from Indonesia for our next masterclass. Thanks very much, everyone. Bye-bye.